Today's market moves weren't just about a recovery in prices, they reflected a dramatic shift in how investors view the government's willingness to intervene in the global energy crisis. After a week of escalating fear, we saw the first signs of a coordinated policy circuit breaker. After 5 consecutive days of heavy selling, markets staged a powerful relief rally. The Nasdaq led the way, jumping over 1.33%, while the S&P 500 reclaimed nearly 1%. The most striking move, however, was in the commodity pits. Crude oil, which had touched a staggering $120 a barrel overnight, collapsed by nearly 8% to settle back below the $90 mark. This move took the oxygen out of the fear trade, causing the VIX to plunge 13%. We also saw a return to risk-on behavior in the digital space, with Bitcoin surging nearly 3% as the immediate liquidity panic subsided. The catalyst for this reversal was an unmistakable signal from the G7. Finance ministers issued a coordinated statement suggesting they stand ready to flood the market with strategic oil reserves. This effectively told speculators that there is now a managed ceiling on energy prices. Adding to this relief was the New York Fed's latest survey on consumer expectations. It showed that despite the headlines, household inflation expectations are actually trending down toward 3%. This gave the market a much-needed disinflationary cover, suggesting that the Federal Reserve might not have to be as aggressive as feared if consumers aren't yet panicking about long-term prices. Institutional money moved quickly today to unwind war hedges and rotate back into growth. We saw a clear short-covering rally in technology and healthcare sectors that had been unfairly punished during the peak of the oil spike. On the flip side, energy and financials were the primary laggards. The crowded energy trade saw a mass exodus as the 8% drop in crude forced trend followers to take profits. This suggests a shift in investor psychology. The market is moving away from panic liquidations and back toward selective growth bets. However, beneath this relief rally, a physical risk remains that the market might be overlooking the reality of regional production shut-ins. While oil prices fell on the promise of reserve releases, actual production in countries like Iraq and Kuwait is declining because they physically cannot export through the blocked Strait of Hormuz. Their storage tanks are full, and they are being forced to shut down wells. Restarting that production isn't as simple as flipping a switch. It's a technical challenge that could take weeks. An interesting debate in markets right now is whether the G7's paper promises of oil are enough to offset the physical reality of these production halts. I'd be curious to hear how you see this developing. Is the market underestimating a second supply cliff later this spring? Feel free to share your view in the comments. Today's move signals a short-term narrative adjustment, but not necessarily a full regime change. The market has accepted that while the geopolitics are still broken, the G7 finance ministers have re-entered the chat. We are moving into a phase where the market is no longer just watching the conflict. It's watching how effectively governments can mitigate the economic damage. This new optimism will be tested almost immediately. This Wednesday, we get the February CPI report. This is the moment of truth for the inflation narrative. If that data shows that last week's oil spike has already poisoned the core cost of goods, today's relief rally could evaporate instantly. We are also watching the enterprise software space, starting with Oracle's earnings. This will be a major test for the software Magellan thesis. We'll see if AI is truly driving new revenue or if the sector is simply stalling under macro pressure. The broader takeaway from today's reaction is that we are seeing a policy-driven bounce, not a resolution of the underlying risks. Growth, inflation, and credit stress remain in a delicate balance. What this suggests for investors is to use this period of stability to reassess exposures rather than chasing a linear recovery. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.